Continuing our discussion, we're going to talk about a long hedge. Brad Williams, Frugal Finance. Stock index futures allow for both long and short hedges, just like other future contracts. Say you have a pension fund manager who believes she is at the start of a long bull market in Japanese stock. At the moment, $1 is worth yen 140. In 3 months, she believes the 6 billion or 42, 857143, or we say 43 million in fresh funds will be available for investment. The bull market might be completely missed if money were to be invested in the stock market after 3 months. Using stock index futures is another strategy to make sure you don't miss out on market movements. There are other tools you can use, but let's just go with this one. To match the anticipated inflow of investable funds in terms of dollars, a money manager might, for instance, decide to buy a certain quantity of stock index future contracts. Assume for illustration purposes that on May 19th, the Nikkei index future contract is trading at 14.4, translating to a cash value of $72,000, determined at a rate of $5 per index point. With the expectation that the funds will arrive in 3 months, investment manager chooses to purchase 43 million worth of futures in order to secure position. What do you have to consider before you do this? You're going to have to look at contract size, future expiration dates, along with some other variables, but we'll just stick with the simple parts first. The manager selects the September contract for its regular expiration and purchases 600 contracts based on the timeline. Why 600? What are they, $5 per index? Value of 72 grand? Yeah, $72,000 is the contract size. 600 contracts by 600, it's going to be 14, market 1470. On August 15th, the Nikkei spot and futures reach 17,760 from 14, up 2.5% or 360 points. As a result, yen 6 billion would not be able to buy the same shares as on May 19th. Nonetheless, the investment manager has made a little over $1 million in future profit, which somewhat counteracts the higher stock purchase prices. It's important to keep in mind that even though the CME Nikkei contract, Nikkei, could be Nikkei or Nikkei, contract is quoted in dollars and is linked to the Nikkei index, using the strategy exposes trader to exchange rate risk, which can be reduced by using exchange rate hedge. Here is the trade. I'm not going to go over it. You can read it. You see we're going down the same path. We're either longing a position or we're shorting a position. We don't have a portfolio in our hands yet. We want to establish a portfolio, so we can use options, we can use forward, we can use futures, and there's probably a few other tools in the toolbox. Brad Williams, Frugal Finance.